Good afternoon and welcome to the SDI Group PLC Final Results Investor Presentation. Throughout the recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all the questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll, and I'd now like to hand you over to Michael Creedon, CEO. Good afternoon to you, sir.
Good afternoon. I just want to do a quick intro, really. I've been here some years now, probably 10 or 11 years, and we're in a different situation this year to other years. So in the last 8 years, we've had a rapid growth within the group through organic growth and M&A. The exponential growth was due to sales from COVID, and this has now come to an end. We're now on a level playing field with other science and technology companies. This year we had a few stumbling blocks on the road, which Ami and I will explain during the course of our presentation. But our business model still remains strong for organic growth and growth for M&A. So if we turn over to page 4. Okay, I'll just do a quick intro on this. So Ami's been with the company for about 12 months now, just over 12 months, and we've also appointed 2 additional directors. As Ami's only been here for sort of 12 months, I thought I'd throw this over to Ami to introduce himself, but also extend that to the 2 non-exec directors, Andrew Hosty and Louise Early, are new on board for us. Over to you then, Ami.
Thanks, Mike. Right, about me. I introduced myself at the half year, but for those of you who weren't on that call, I'll introduce myself again. As Mike said, I joined almost exactly 1 year ago in August 2022, and I spent a large part of my career at Ultra Electronics, which was a FTSE 250 aerospace and defence company. It was a decentralised manufacturing group with a small head office, and I was part of the team which embarked on a buy and build strategy in the early 2000s. I'm not the only new director though, as Mike said. We welcomed Andrew Hosty to the board in August of 2022 as well. He's a non-executive director on multiple boards, as you can see from his profile. He was the Chief Operating Officer of Morgan Advanced Materials, FTSE 250 decentralised manufacturing group with a small head office. And he was on their board, the PLC board, from 2010 to 2016. And he's an engineer by background. We also welcomed Louise Early to the board in February of this year. She's an executive with the Halma subsidiary Navtech Radar, and also sits on the board of Sensit Technologies, which is another Halma subsidiary. She's a marketing and commercial executive, and she started her career in engineering. Back to you, Mike.
The next page, page 5, group overview. So the strength of our business model hasn't really changed over the years. It's due to having autonomous business units, but the wonderful word synergies is actually coming through, and we'll see this through the presentation, early stages. And as we acquire additional complementary businesses, we hope to enhance the collaboration between the businesses. The second point is we all acquired businesses must be profitable and cash generative. We don't rely on a single sector of regional trading. That's why we actually did very well during the 2.5 year period of COVID, and we acquire businesses and invest in growth. And I'll give you some examples of that as we go through the presentation. And you've seen on the diagram on the right many times over the years that it's got larger with the additional acquisitions we've got, but also in the roadshows we've had in the last few days, a lot of people have actually said to us about the sector split. It's very difficult for them to get an analysis of that. So Ami, do you want to expand on that, because you were talking to these investors about this split going forward, or you're questioning it anyway?
Yeah, I mean, historically we've been segmented as digital imaging and sensors and control, and it's not inconceivable that we'll reconsider that sort of segment split going forward. We haven't actually confirmed that internally yet, but it's likely that we will segment the sensors and control division into lab products and industrial products. So watch this space. It's likely to happen in FY24, because most recent acquisitions have all gone into the sensors and control division. So just forewarning you all that this is likely to happen at some point in the near future.
Okay, just the last point before we go on to the next slide. Throughout this presentation, we'll mention collaboration and synergies, which are new to the group, as I've already mentioned. As a starter, we've seen a collaboration in, as Amber's just mentioned, the lab group, which consists of SafeLab, LT Scientific, Monmouth Scientific, Synoptics, and Applied Thermal Control. But I'll give you further details as we sort of skip through this presentation. So we go on to the next page, which is a new slide for us, really. Oh, sorry, I've gone the wrong way. Sorry. It's a new slide. It's UK and world presence. So it just shows where all our sites are around the UK and the world. So we currently have 16 sites in the UK and 4 overseas. In Lisbon, Dresden, Frederick, that's near Washington, DC, and in Shanghai. Let's just sort of discuss very quickly the 2 new ones, which are Dresden and Shanghai. They're new additions to the group, and that was via Fraser anti-static techniques. The Dresden one was purely because when we came out of Europe, they needed a German subsidiary so they could invoice their German customers. So this was set up, and it's really just a sort of PO box number. All the admin, etc., is actually carried out in the UK, and it works very well, and our customers are very happy with that. Of interest to me, really, is a subsidiary in China. It was a distributor they'd known for a number of years. He wanted a piece of the action. So they sent this subsidiary up. George Fenn, the general manager, he owns 60% of that business. We own 70% of that business. I was supposed to be going over there this week to do a presentation because of the delays in the accounts that are sort of canned. And what he would like to do is for me to present all the other 13 subsidiaries and their products, because he thinks he would be able to sell some of the products. If not, help us find distributors in China. We do sell into China, but it'll be an interesting exercise to see whether he can actually broaden the depth of our sales going forward. So if I hand over to Ami now, and then he can go through the numbers with you.
Thank you. Thank you, Mike. So the first slide, this slide illustrates the global nature of SDI today and gives you a snapshot of our current scale. Revenues, 68 million in FY23, and about half our business is international now by destination. We have over 500 employees, and as Mike has just said, 20 locations. So moving on to the results. This slide shows the highlights for the financial year. You'll have seen these earlier in the week, so I won't spend too long on this particular slide. Strong revenue growth of 36%, driven by acquisitions, and the significant Attic cameras contract for cameras that go into PCR machines has come to an end in FY23. And the organic growth that you can see on this slide excludes this. All of the adjusted measures, including adjusted operating profit, show some growth, and we generated cash of around 11 million over the year. We booked a non-cash impairment of 3.4 million net of deferred tax against Monmouth uniform goodwill and intangibles. This is one accounting entry that's impacted all of our reported results, and I'll talk about this later on. The underlying tax rate has risen this year due to deferred tax adjustments from the prior year. This slide shows some extracts from the income statement. The headlines from this slide are total sales growth was 17.9 million, of which 17.5 million came from acquisitions. The next slide will be a revenue bridge, which will illustrate the impact of the end of the Attic PCR contracts on our organic growth. Gross margins include a mix effect, with our acquisitions having slightly lower gross margins on materials than our existing businesses. Excluding this, gross margins increased on a like-for-like basis. We managed to pass on most of our cost increases to our customers. Adjusted operating profit grew by 6% to 12.8 million, and due to higher interest rates and increased debt levels over the second half of the year, adjusted PBT increased by just under 1% to 11.8 million. The impact of the 3.5 million non-cash impairment charge on our reported results is visible here. As a result of this, reported PBT and reported our profit after tax show reductions. The impairment is not deductible for tax purposes, so the fully diluted EPS is particularly impacted. Adjusted diluted EPS grew by just under 4% to 9.02 pence, with the FY23 effective tax rate increasing to 20.7%, largely due to deferred tax. As a side note, it's worth mentioning that the group's FY23 return on average capital employed, using adjusted operating profit and after adjusting for the impairment, is 27.6%. We do now have about £5 million worth of properties which impact upon this percentage. This slide shows how the revenues have moved compared to the equivalent period last year. As I mentioned already, acquisitions contributed £17.5 million in revenues. 11.2 million of this came from FY23 acquisitions and 6.3 million from FY22 acquisitions up until the anniversary of acquisition date. The impact of the one-off attic business for cameras that go into PCR machines is shown here. As we've said for some time, attic's COVID-related business would come to an end, and it has this financial year with the last delivery in February. Revenues for this business reduced from £10.9 million last year to £8.5 million this financial year, a reduction of 2.4 million. You can see this on the right-hand side. Excluding this, organic growth was £2.8 million, 7.2% in absolute terms, and 6.4% on a constant currency basis. I'll now spend a few minutes talking about Monmouth. Monmouth was acquired in December 2020 for £6.1 million net of cash during the pandemic. At the time, it sold a large volume of biological safety cabinets, which drove its pre-acquisition profits. This sales mix has reverted to a more normal mix, which requires more labour effort for an increased number of installations. Furthermore, Monmouth has moved into a new purpose-built facility in April 22, the costs of which were higher than anticipated at the time of acquisition. We are annually required to do an accounting exercise, checking the value of goodwill and intangibles is still supported by future cash flows. In the higher interest rate environment, our weighted average cost of capital has increased, and the forecast for Monmouth and Uniform have become more prudent. This has resulted in an impairment of 3.5 million, but it does not impact upon the cash flow of the group. It's important to note that Monmouth has remained profitable since acquisition and is forecast to remain profitable in future years. It's also worth noting that if we had accounted for leases under the old way, i.e. before IFRS 16, the impairment would have been about £1 million lower. Business has a new management team, and we are hopeful that Monmouth's performance will improve to the levels that determined the original goodwill valuation. This slide shows the performance of our digital imaging segment. The digital imaging segment comprises three businesses: attic cameras, Synoptics, and Graticules Optics. All our other businesses are in the sensors segment. As I talked earlier about the attic PCR cameras, revenues reducing by £2.4 million. If you exclude this, the digital imaging segment grew by 16.4%. If you include the PCR revenue movements, organically the segment declined by 3%. Encouragingly, attic cameras grew by 37% organically outside of the COVID-related sales. This slide illustrates the performance of the Sensors and Control segment. All recent acquisitions have joined the Sensors segment, and as such, £17.5 million of this segment's growth have come from acquisitions. The segment grew organically by 3.8% outside of this. Looking at trading over the period, Sentech, Chell, and Applied Thermal Controls all had very strong trading years. Sentech experienced strong demand for its chemical sensors. Chell produced a smart meter calibration device for a large OEM, and Applied Thermal experienced very strong demand for its chiller products. Both LT and FAST joined the group this year, and both have been earnings enhancing to the group, and we're pleased with the progress so far. Turning to cash. Working capital increased by £4 million over the year. Inventories increased by £2.9 million. Of this, £2.1 million was used to mitigate against component shortages. A further £800,000 related to one business, Scientific Vacuum Services, who spent much of the year building a sputtering machine for an OEM customer. Customer advances reduced by £3.5 million due to £2.7 million worth of COVID contract-related cash flow at ADSIC, which unwound in the period, and £800,000 from a pre-acquisition advance at LTE, which also unwound. Other working capital reduced by £2.5 million. Cash generated by operations was therefore £10.9 million this year. Interest payments increased to £1 million as a result of the higher debt levels over the second half, as well as increasing interest rates. SDI moved into the large company tax instalment payment scheme this year. We also paid £400,000 of tax in relating to prior period acquisitions. This resulted in the cash tax increasing to £2.1 million. Most of our acquisition consideration was funded from our bank facilities. You can see this more clearly on the next slide. This slide shows the working capital movements I've spoken about and the £21.1 million in acquisition costs. These were funded by an additional £15 million in bank borrowings, and £3 million of these borrowings have been repaid by the year end. Some comments now on our financing position. The revolving credit bank facility was extended by a year to expire at the beginning of November 2025. We can extend by another year at HSBC's discretion. At the end of the period, the net debt to EBITDA covenant ratio was 0.9 times, comfortably inside the ceiling provided by our bank facility. We have £9 million of headroom, plus a £5 million accordion option available to us, again at HSBC's discretion. The acquisition of LTE Scientific cost £2.8 million, net of cash acquired, and this acquisition cost included the property, which is worth £1.7 million. Fraser Anti-Static Techniques required consideration of £12.8 million, net of cash acquired. This included fast properties for £1.8 million. A further £2.4 million was paid to the Safe Lab System sellers to close that particular transaction. And at the end of the period, we had £1 million in deferred consideration. This relates to the acquisition of SVS and will be assessed over FY24. That's all for me. Over to you, Mike.
Okay, we got it. Cool. So it's me now. So I'll just take you through the last pages of the presentation. So if we look at LTE, we discussed this. I think it was at the interim stage. It's a pretty similar slide, but I thought I'd have an opportunity to give you an update of where we're at and what LTE is doing. So it was acquired, as it said on the can, in August 2022. It's a manufacturer of autoclave sterilizers, environmental rooms, endoscope storage cabinets, and laboratory ovens. This year, the main sort of source of revenue and profitability from this business has been the environmental rooms. It's been a lucrative source of sales revenue for us. We acquired this business with a 3-year average PBT of about £300,000 a year. And since acquisition, we're reporting annualized PBT of £600,000. So it's been a fantastic acquisition for us. I think there were some question marks about it in the early days, but to me, it's a very good business in the way of its profits and revenue. But I'll explain some more as we go through the presentation. And we're pleased with the management team as they are focused on growing the business. So we've actually got John Lees as the MD, and Zoe Turner, she's the production director. She's a newbie on the block. Also, I'd like to sort of highlight, I keep saying about this sort of collaboration and synergies around the group, but there's some people we commended here, and that is sort of John Lees is the MD of LTE Scientific, and Roger Guess, MD of Safe Lab. So these are new guys on the block, and they're aiming at driving growth by collaborating with the companies in the group. And these include, as I mentioned before, Monmouth Scientific, Synoptics, and Applied Thermal Control. And I keep saying this is a new territory for the group, but because we always actually stated right at the start, what do we look for? And that's autonomous business units or federated structure, same old thing. But we still want that in place. But what we can do is actually to gain additional revenues through total lab solution packages. So I think it's an interesting exercise. So we've got our first face-to-face meeting with the group on the 2nd of October, which is pretty exciting, I think. the next area really is the acquisition. When you acquired the acquisition, we had a 44,000 square feet of freehold property. You can see it on the diagram in the bottom right-hand corner. It's right stuck in the middle of a housing estate in Greenfield, which is on the outskirts of the Peak District. Very pretty area. We're the only industrial unit within the town. The only other one of our size is the Tesco's, and that across the road. That's about it. So myself and the management team, about 3 weeks ago, I think it was, or thereabouts, that was John and Zoe, we discussed the future for LTE and its facilities. This building's pretty tired and it's expensive to run. It costs about 200,000 quid in electricity bills. So, and when you compare it against the other 13 businesses or 15 sites, it's bloody expensive. So what we're actually doing is we're currently reviewing whether we actually move to a more smaller unit. So we're probably looking at 30,000 square feet building because there is a lot of old engineering units or plant and machinery written down we don't really use anymore. And it will provide a better and probably more efficient working conditions. This is early stages in discussion. And what will we do with the building? Well, we bought it with a valuation of 1.6 million. It's still there or thereabouts. What we could probably do is Andrew Hosty, our NED, did mention about change of use. So we're actually looking at change of use and also planning. So it could be sold for housing. This is, like I said, in the early stages of the group. And that's for us, that'll be extracting cash from these sort of assets, and then we invest it in projects which will give a higher return than the yield on the property. As an interesting sort of fact, sideline is when we actually were looking to acquire LT, so was another body, and all they was the building. So they weren't too concerned about the business. It was just the building, and to do the same as we're actually intending to do with the building. So if we go on to the next slide, let me have a look. Sorry, there we go. Cool. So it's the same thing with this one, Fraser. We discussed this at the interim stages, same old slide, but again, let's give you a little bit of an update of where we're at with, 7 or 8 months on. Anyway, so we acquired that in October 2022. This is the most expensive deal we've had, and you can actually see how big the debt is. Well, that is mainly due to this business here. It's a leading manufacturer of anti-static products, and it's involved with a variety of businesses, as it's listed here. But just to highlight sort of three, the main interests for this business are plastics, packaging, and printing, and that produces a lot of static electricity. So what you've actually got is an anti-static product which is bolted onto the machinery to drive away the anti-static. It operates again in a freehold site in the middle of Bampton in Devon, and it's got subsidiaries in Dresden and Shanghai. This is a sort of strange concept when the housing estate was built. The housing estate was built, and what they actually wanted to do was to bring in some industrial units into the middle of the site. I don't know why, but prior to us sort of acquiring the business, Bob Fraser actually bought all the industrial units. So I think in an early presentation, you actually saw the buildings. I think they were trying to get little starter units, but that didn't happen. We've got the whole site. As with LTE Scientific, I'm not in favour of acquiring properties, as it's a far lower return that we should be able to get on an investment, looking at investing in our current and future businesses. But we didn't want it to be a deal breaker. So this is an action with Amy and I have got that we need to review going forward. Next page is operations and synergy on this page. So what we've got here is, I wanted to backtrack, to tell you the truth. I just thought of something else I wanted to mention as well. And that was, it's in there about sort of James Cater. Yeah, sadly, Bruce Clothier, the MD, he decided to retire for personal reasons a few months ago, which is sort of really sad, really, because he was a really great guy, and I really got on well with him. But he did provide us with adequate notice. I think it was about 6 months' notice to find a replacement. So we found James Cater. His background is completely different to Bruce's. James is on the sales and marketing front, and this differs to Bruce, who was really involved with production, general manager, that sort of thing. So there's a gap between the two roles. But there was no worries there because they've actually got a really skilled resources within there to support James on a day-to-day basis. So really, it's somebody who's going to have a look at it more on the strategic role going forward. So what we actually did plan, I was saying to all the institutions, was when we were recruiting James, we decided that the best way forward for this new person was for James to recruit him, not for us. And then he can actually bring in his own sort of person for this role. And as I mentioned earlier, I'm still keen that the businesses take advantage of our sales and marketing results in China and use Fraser China as a vehicle to sell their products. And now let's get on to the operations. Sorry about that, just missed it. Operations. So what we've actually got there is I'd like to give you sort of a few examples of some of the interesting projects we've actually got or undertaken in the group. Just two really, so we're not too bored of it. So Scientific Vacuum Services, that's a niche company, and it designs and manufactures high-end sputtering deposition equipment. What the hell is that? Well, what it is depositing a thin film of material on a substrate. Within this case, as Ami's already mentioned, it's a razor blade. So this machine will coat 416,000 razor blades in about 20 minutes, costing the customer 1.8 million, plus a spare parts pack, which is about 200,000. SVS, or Scientific Vacuum Services, has sold a number of these machines over the years. The first one, I think, started at 90,000, and then it went up to about 250,000 razor blades in about 20, 30 minutes. So this is one hell of a beast. The machinery has been factory acceptance tested, so there's no worries on that score. And the customer is absolutely overwhelmed with the machinery. We were due to ship it some months ago, but what has actually happened with the customer is that pleased with the machinery that they're bringing their R&D department from America over to see it, from the UK, and also hopefully for the next customer. This one's going to Mexico, by the way. And so it's delayed for a couple of months while they actually bring their the party of the customer over here. Why? Because what it has to do, it's a fair old size machine, is going to be stripped down and then shipped to Mexico, which is going to take a couple of months. So they'd rather see it working in our environment. And by the way, as already mentioned, there is another one hopefully due, and there's an interest from the customer to actually replace some of the low sort of turnover ones at 90 and 200,000 units to be coated in the near future. The one to mention is Applied Thermal Control. That I felt sad for Robert, the MD there. It was a really hard time for them selling chillers. Two industries they're in life science and engineering. As we all know, everything's shut down. But he's come out of it very strong. And last year he had record sales and profits. And this year is going really strong. One of the reasons is because the US is onboarding, i.e. it's bringing all its semiconductor manufacturing back into the US from Asia. And these semiconductor plants, I think it's Intel, they require cooling, and that's what we're doing. We're providing the chillers for the semiconductor plants. The next sort of category on this schedule is investment. What are we doing with our subs? Well, some examples of that is we've just bought a CNC machine for ASIC Lisbon, and that will shorten product development times. I think we've actually got one down for Shell as well in the near distant future, as it's a lot more cost efficient and time saving actually doing your own CNC or your own machining in-house than actually sending it outside. The other area we've discussed on a number of occasions over the year is the refurbishment of Grashkills in Tunbridge, old 1960s building. We've completely gutted the interior, and it's a really up-to-date, modern chemical collection facility. 2/3 of the products I've mentioned before is Grashkills. So what we got there, I think it's 5 laminar flow cabinets and a clean room. So it's all coming to an end in the next sort of couple of months. And the good thing about it is they actually worked right the way through the refurbishment exercise. It's a bit of hard work, but it's all coming to an end. Last one there is laser etching machines. You probably think it's quite boring, but I think it's quite interesting. And that is the first one we bought was for MPB Industries. Then we did Grashkills Optics, and that was followed by Scientific Vacuum Systems. Let's give some examples of their use. So with MPB, it's precision engraving on glass. So with the flow meters, we actually put in the ventilators through COVID. we're engraving on the side. It's like a test tube, and that was used to be undertaken manually. So we've taken that away, and now it's all done through automation. Another example, which is very exciting, is scientific vacuum systems. So they've got a very expensive machine there, and what we're actually doing there is engraving part numbers on each component. And we had to do that for this machine we've just discussed, this sputtering deposition machinery. And they're very sophisticated machines. Also, what you can actually do with these machines is engrave a QR code or barcode as well. So when you take a part off, you can scan it and automatically email it to us or to your supplier, and then they can actually easily determine what the part is and then ship out a part. So it's good leading technology. Back onto the word of the day, synergies. I'm very enthusiastic about this, and what action are we seeing within this? Let's have a quick slurp. About October last year, we decided to put together a group marketing meeting. Marketing these days has changed fundamentally. When I first joined this business, it was hard copy bound catalogues. These days it's using social media, which my daughter's involved in. So it's using Twitter, LinkedIn, etc. Different way of actually marketing, completely different. What you're trying to do is to drag people to your website. So what we decided to do, first of all, we had a Zoom call last October. And then this year, a couple of months ago, we organised a meeting, face-to-face meeting in Weston-super-Mare at Rogers Place, Safe Lab. And it went down very well. I think we had about 9 of the marketing people, all young kids there. I think it's the most nervous I've ever been on a meeting, but it went very well. So what they were discussing is ChatGPT, as you've heard on the news. People are using that these days. We're using YouTube videos as well. I think one of the good ones these days for us is Attic cameras. All these are done in-house, so we don't use professional people to do it. And that's how YouTube works. I don't know what other exercises we've actually got. I think they're the main ones. Oh yeah, also as well, what we were discussing is, especially with the lab group, there's a big exhibition called Analytics in Munich to say, should we actually combine all the business units into one stand? There are many stands. It's just like when you go to the NEC with specialist areas. But when I went last year, you get people like Amatec, they're all under one roof. So it may be worthwhile looking at that going forward. The other area is group tenders. This is what I've been harping about right the way through the presentation. So what we have, as you can actually see, is an opportunity to tender on Canary Wharf. There's a science lab, just like Cambridge Science Park, just down the road from where I am today, being put up on Canary Wharf. I didn't realise that this week HSBC and a lot of the financial institutions are moving out of Canary Wharf, so they need to replace it with something. So they're looking at planning permission, I think, was in place a couple of weeks ago. And what actually happened, we've actually found out through Roger Guess of Safe Lab who the building contractor is, which is Keir Construction. He knows the procurement director. I suppose it's who you know in this world. So what we actually did was put together this flyer you can actually see on this page with all the business units on there. He had a meeting, so he was chairing it, and we'll see where it goes. I think it's a couple of years away, but it's something we can actually focus on. Now we've actually got 14 business units, 17 acquisitions. It's an area where hopefully we can actually sort of gain additional revenue streams. It's all right, my screen's just died. The last point is we've been running this for sort of 3 or 4 years now, is group strategy sessions. That's in Quay Mill, it's in Stoke-on-Quay, if you know Cambridge at all. So we usually hire that out for 2 days. And what we're actually doing is just like Amy and I doing this investor presentation to you chaps. These guys will do a presentation to all the subsidiary directors and senior managers, myself, Amy, and the non-exec directors. And then there's Q&A from the floor. It worked very well. We stopped it during COVID. It started again last year, and then we're going to go introduce it again. I think it's in November this year. It works very well. Like we actually said, synergies work in some instances, but it's good when people get in a bar and have a drink and talk about business. You know, a lot of founders have got a lot of knowledge about business and running businesses, so it's worthwhile, you know, people actually sitting down and listen to these guys. And let me flick onto the next page. What do we got here? Oh, yeah. growth drivers. You've seen this on many occasions on these presentations, so I won't spend too long on it. Yeah, this remains unchanged. Organic growth, yeah, it's still going there. We're still getting organic growth. We still expect organic growth to be, well, it's actually said here, organic growth to be 5 to 10%. Yeah, I always like it to be in the high single digits. That's my aim. M&A, no change really. We're still doing on average probably 2 or 3 businesses a year. The last one was Fraser in October, so we did 2 that year. I'm sure we'll do 2 or 3 in this financial year. And we acquired 17 businesses since February 2014. We've merged a number of these businesses, so we've actually got 14 operating units, and we've got a very strong pipeline, and we've got a number of strong opportunities that I hope we will be able to crystallise in the short term for the group. And I'm afraid it is the last page of this presentation. Summary and outlook. Just to sort of repeat what I said earlier on, it's been a challenging year in comparison to previous years, and I'm disappointed that I was unable. I've actually said this for many years. Previously as a finance director, but now as the CEO, my personal goal was to deliver shareholder value, and it's difficult for me. So I'm actually quite disappointed for this year. We still continue to sort of grow organically and through M&A. Trading for the first couple of months has been pretty good for us. We've got a strong pipeline of acquisitions there. I feel pretty optimistic sort of going forward. I'm afraid that's it from me.
Perfect, Michael, Amy, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right corner of your screen. But just while the company take a few moments to review those questions submitted today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the Q&A, can be accessed via your investor dashboard. As you can see, we received a number of questions throughout today's presentation, and we also received a number of pre-submitted questions. And Amy, at this point, if I could just hand over to you to share the Q&A, that'd be great, and then I'll pick up from you at the end.
Great. Okay, first question. Do SDI management look for high growth opportunities amongst the existing SDI group constituent companies? Is it not the case that there's a possibility that there is a better growth opportunity for the group amongst existing group than elsewhere? In other words, do organic growth compete with acquisition opportunities for the free cash flow available to the group? The answer is, Mike, you're on mute. And so the answer is that no, there's no competition here. We look at every opportunity on it on an individual merits. There's no competition in that way between acquisitions and existing group. And if there are opportunities to invest in existing companies, we will do that. And we have done to generate organic growth. So we look at each opportunity on an individual basis.
Yeah, I just
anything to add to that?
Yeah, good point. Yeah, there's sort of two areas where they have an opportunity to shout for investment. That is one at the budgeting stage, and then one at the strategy stage. So we're looking at short term and medium term, and we'd never sort of turn it away because they're the ones who are running those businesses, and they know more about it than Amy and I. So it's never happened.
And that answers the next question as well, which how do SDI management apportion reinvestment in existing group companies? As Mike says, it's through the budgeting process, and we work through each investment proposal. Were you surprised at the market reaction when you announced at the end of the one-off pandemic-related orders, given you had advised that there were one-offs? Mike?
Too bloody true I was shocked. To tell you the truth on this aspect. Yeah, I know in May we actually said about the trading update, but this time round I was really shocked, to tell you the truth. And also, Amy and I had a really busy time in the city, and it wasn't sort of negative. They actually understood what was actually going on with us. You know, at the end of the day, we're still generating plenty of cash. It's just that through accounting standards, we had to take this write down. But at the end of the day, we're still generating cash. The model hasn't changed. It's still buy and build. We invest for organic growth. So to me, it's still a good, strong business.
What are the monthly metrics you look at for all subsidiaries? Well, I look at sales versus budget, wages versus budget, overheads versus budget. We look at debtor days, creditor days, stock day and stock days, level of stock, gross margins. So there's multitudes of things that Mike and I look at every month for each company in the group. Anything you got? Nothing to add there, Mike?
No, you said the list.
Yeah. As you get bigger, is it becoming more difficult to find acquisitions that can provide the returns that you've achieved in the past?
Not at the moment. I think the problem I've actually got at the moment is delays. As I've actually said in the city, I think it's October was the last time we did a deal. I'm sure we should have done one, in my view, probably May time, but it's just drags out. You do the DD, you shake hands, and then you hand it over to lawyers, and what happens? It sits there in a box somewhere. So I'm still confident we're going to do sort of a few this year. Ami's got the cash there to do it, so I can't see any reason why we shouldn't. The multiples haven't changed at all. We're still looking at between 4 and 6 there on goodwill. So I can't see any reason why not. Over to you, Ami.
Okay, as you no longer expect any more orders from the PCR OEM customer, how do you expect earnings and free cash flow to trend over the next several years? I know you have said that you aim for single-digit organic revenue growth. And I'll answer this one. I'll answer this one. So, we do still consider single-digit organic growth. Earnings will continue to grow as a result. Clearly, interest rates are higher. So as long as we have debt, then those interest charges will be a factor. And tax rate is increasing to 25% for everybody. So that is a factor for everyone. But earnings should increase. Free cash flow, the sort of working capital unwind that you saw this year will not happen again. It's not likely to. So free cash flow will improve over the next 24 and beyond. We do expect it to trend upwards. Will you consider share buybacks anytime soon? The answer is probably not. The best use of our cash currently, I think, is to buy companies, acquisitions, and that generate greater shareholder return. But buybacks are, clearly we do consider them, but at this point we have no plans to do so.
I agree, Ami. Yep.
When you look at large industrial conglomerates like Amatec and Danaher that run a decentralized model while also implementing a system of operational excellence, do you envision SDI as following that sort of playbook? That's a tricky one. I mean, part of the reason I'm here is help us grow, really, and obviously I've been in larger companies, decentralized companies, and some of the board have as well. Alongside Mike, we all sort of see the growth path, and we'll expand our headcount and all that sort of stuff in line with, but it's at the right time for the organization. So we will develop our organizational structure as we go along, as we get bigger. Mike, you have anything to add?
No, I just a couple of points on that, and I support Ami on that. If you look at, I think the classic model is Halma. Halma were like us in the 1980s, and as they grew, people were doing 3 jobs for one. Then they had to increase the headcount and the structure. So I'm just concerned that you actually increase the structure before the revenues come in stream, but we're not doing that anyway. So I agree and support Ami on that.
Hi, Mike. Please help us understand better your thinking behind the company's acquisitions over the last 2 to 3 years. Some of them don't look cheap optically, i.e. high enterprise value EBIT multiples. I guess that's because you expect earnings to improve significantly near term. However, the Monmouth case makes one question the quality of these acquisitions. Grateful if you could share your thoughts on your acquisition criteria going forward.
Okay, 2 parts to that. So first of all, the acquisitions, I think what you need to do is do for the board is actually separate the total cash consideration. So what we're doing is, first of all, we split it into 2 or 3. So first of all, part 1 is goodwill, what we're paying for goodwill, and that's usually a multiple of profit before tax. We take a 3-year historical average. Sometimes it could be an earn-out, but it's also a very short earn-out, and multiply that by the multiple. It's 4, 5, or 6. The highest we've ever paid was at Fraser at 5.8 times, and if you go further down, it was 5.5, 5.6 times for SafeLab. Our lowest was at 4, so that's what we're paying. Then on top of that, we pay for net assets. We never pay for the cash; we hand the cash back for that. But the problem is in recent acquisitions, the net assets have been very high because we're buying property, and that's where it skews it somewhat. So in some instances, you don't actually see that in the broker's note. But I've actually said to the brokers, and this is what the people were discussing this week at the investor presentation. So it's twofold for us. It's the amount of net assets and the goodwill. So it skews it if you actually look at it as a total sum. Well, and got Monmouth. What have we got for Monmouth? Is that the Monmouth?
Well, quality of these acquisitions, if it just makes one question, that is the...
Yeah, I think Monmouth, people say, what's your thoughts on Monmouth? Well, we bought it at a 3-year historical, so it was making 500 for a couple of years, and then it had a really bumpy year with COVID. It made 1.6 million. 3-year average was 800,000, which was fair. But the stumbling block was the property. There are 6 or 7 properties scattered around Bridgewater. They'd already got planning in place. They've already got planning in place for this property, and I think it just got out of hand on the fit out for it. Did we get it wrong? I don't think we got it wrong. We might have probably got it wrong on a multiple of 5. It could have been 4 to 4.5. So the numbers are not that big. But nobody can look in a crystal ball to say what's going to happen after COVID. Because at the end of the day, they were shipping 10 to 15 biosafety cabinets out to hospitals, trusts, etc. It only needs 1 or 2 service engineers commission. That model's changed now. We're shipping 2 or 3 and a variation of other products. So your overhead base goes up. So your service engineers you need more service engineers. One of the biggest problems we've actually got is finding service engineers. So we've actually got service departments in a lot of the businesses. One of the question marks is, do we share those? A good example is LTE, Scientific, Safe Lab, and I just mentioned Monmouth. Have all got big engineering teams with vans. Do we share it? I don't know. It's something we're talking about at the moment. So this is all part of this sort of collaboration we're talking about. So it's hot off the press, really.
Can you confirm whether you're seeing any changes in valuation expectations from vendors in the current market environment? Are you still aiming to get 4 times 6?
Yep. No change.
Okay. Next one. In the past, you've said that the target is to have mid-high single-digit organic growth. 23 was lower, even excluding one-off from Attic Cameras. What is your current view on the organic growth going forward? Well, actually, it is. If you exclude the Attic Cameras revenues, then the organic growth was 6.4%, which is within the sort of range that we talked about.
Yeah, I thought that. Yeah.
So I think so we're quite happy that the year was actually within our line of what we expect. So I'm not sure quite what you meant by this one. So this is a question about impairment, and they're asking about headroom on are there any other headroom issues on other companies? Well, can I guide you to note 8 of the press release, and that talks about headroom and other companies, because it is there in the press release. You don't have to wait till the annual report to have a look at that. Next one is an interesting one. Operating expenses excluding impairment are up an eye-watering 51% year on year versus 22. It's a much larger increase, and revenues up 36%. Yeah, it is, but it includes acquisitions. So that's the bit both 22 and from FY22 and FY23. That's all in there. You got an annualized 12 months of 22 against the shorter stub period in the prior period, and you got the full half a year or whatever for the acquisitions. So, but yes, they have gone up, no question. Lots of reasons. Trade shows have restarted, traveling has restarted, audit fees are up, salary inflation is there. We haven't been able to avoid it. We have put increases up on it for our payroll, for our lower paid employees. So clearly we're not immune to the sort of inflation out there. But yes, it has increased. And no, your point is well made. Anything to add to that, Mike?
No, none at all.
Okay. Bank debt at 16 million at the year end. In the absence of further acquisitions, how fast do you expect that bank debt to be repaid? Circa 2.5 years is probably, depending on how quick we can get the cash in, circa 2 years, I would say. Is it possible to explain the impairment of 3.5 million in relation to the profitability of those companies? I think you have done. We may have done. The cost of the property cost was circa about 400k higher than we anticipated, and that's. But you bought it for multiple. What was it, Mike? It was
4 times.
4 times, about
5 times.
Yeah, 5 times. So it's about a few $100,000 off the profitability of those 2 companies, but it's still pretty profitable. These are still profitable companies. Monmouth, the CGU is profitable. Will the increased interest rates influence your decision to fund acquisitions through your debt? In other words, is there a scenario where it's better to pay off debt in the current environment?
Good question.
It is a good question. Clearly, the accretion on acquisitions is less with the higher interest rates. That's no doubt about that. And you have a higher tax rate as well. But we don't buy businesses for 1 to 2 years. You buy them for 3 to 5 years beyond. And our model is to increase profitability of these companies. So I don't think we see any change. But yeah, there is a scenario where it's better to pay off debt. I'm not sure we're there yet, but I don't think we are. And do you have anything to add, Mike?
No, not at all. It's perfect. That's what you've been saying all the way through the sort of
last
4 days.
Last few days to
yeah.
most investors. Is a new management team at Monmouth hired from within the company or from outside the SDI group? They're from outside the SDI group.
Grey area on that for the managing director Julian Mussett. He's ex-Merck, but would already include recruited him as a sales director on a short-term MD role. He's now a consultant. He decided he didn't want to stay on for that long. He's still around helping us, which is a nice guy. And then Kim Locke, she is the finance director, but what she also does is operations. So what we've actually got within Monmouth now is a similar sort of management structure to all the other 13 subs as well. So you've got 1 or 2 directors and then senior managers. Before it had an MD and 3 directors, 3 very expensive directors. But we've actually sort of farmed that back now, and it seems to be working. And what we're actually trying to do with Julian, as it's new, is again is the collaboration. So we've had a couple of subs, MDs going down there, really to look at fabrication at Uniform, and they've stopped in at Monmouth. And what they've actually found is they've got a fantastic sort of portfolio of products, which is ideal for overseas, for the overseas market. But they've got quite a limited distributor base. But the likes of LTE, Apply Thermal Control, and also Synoptics, I've got a massive distributor base. So we're trying to sort of making sure he taps into that base, because there's no point in inventing the wheel when it's already there. So that's what we're trying to do with it. So I went out a bit on a limb on this, but I thought I'd covered it. That's okay.
How would you calculate the total addressable market for SDI? That's actually an impossible question at a group level because of our business model. We have 14 companies, most of whom are in different markets, different segments, other than lab products. Outside of lab products, you've got, each business has its own total addressable market, which is completely different, independent of each other. So it's not a question with our business model that we can actually answer. How much of the revenues are recurring and non-recurring in each division?
I've worked this out when you were talking.
Okay, good. Very good.
Cool, eh? I haven't done it by division. I've done it in total, really. So, and it's roughly what we thought, about 20%, but I'll just highlight some areas. So virtually all the businesses actually sell spares, but the service side, the bulk of the service I've already mentioned is LT, Safe Labs, Monmouth, Astles. It used to be 50% of their revenue was service. I think it's going back that way now with Astles. SBS, they sell a batch of spares I've just mentioned with a Razor machine, and Apply Thermal Control. So they're the ones who offer spares, which is about 6 million. And then you've actually got businesses which is solely recurring revenue streams, which is Centec, Sensors, and Graticules, and that is about 7.5 million. So in total, it's about 13.5 million. So you're looking at 21% off the top of my head. So it's not far adrift, I don't think. There you go, Amy.
Very good. The next question is me. The question is the net debt, and we refer to 13.3 million, and the balance sheet shows a figure of 22.7 million. Difference is lease liabilities. We don't classify lease liabilities as debt in the same way. Most banks don't include IFRS 16 lease liabilities within their debt calculation. So our banks will look at net debt without lease liabilities. That's the difference. How do you reduce the risk from acquisitions failing? That's a very good question.
Bugger me.
It's a due diligence.
We do due diligence, but you still don't know what's underneath it. I think the classic one is Monmouth, but we didn't know that COVID was going to end. That's the biggest one. But we've had another problem, and that was issue, and that was with thermal exchange, but we rectify it. So for us, on my view on it, is when we look at acquisitions, is to make sure that one, as Ami's rightly said, it is DD, but not overextend, because if we overextend and get too big an acquisition, then we're in the limelight. At least if we actually do nice niche ones between £500,000 and £1 million profit, at least you've got some bandwidth to get out of jail on, really. But if you actually really extend yourself, you're knackered. A good one we looked at was a really good acquisition. It was turning over, I don't know, 20, 30 million. Fantastic acquisition, but the only customer base was the NHS. So Amy and I discussed this and said, no, if that fails, we're knackered.
I mean, we also introduce people, improve quality of some of the people. We might get a qualified accountant, perhaps, to be the financial controller. You upskill some people as well. There's various different things you can do. We do mention it in the annual report as well as a key risk. Share repurchasing, I think we've said that we're not at this point we're not going to do. Can you explain management M&A process, for example, criteria that need to be met, the number of targets, valuation? We haven't got long enough, I don't think. Management criteria, your DD process.
Okay, well, the DD process is, I've just sent it over to one of the institutional investors about interest. It's like a 50-page document. So what you're actually looking at is a constitution, personnel, property, patents, legal litigation, IT. You're looking at so many different so much information within the potential acquisition. It's not that difficult. It's probably a week, 2 weeks work, and it's a good way of actually speaking to the staff. And a lot of occasions, we know this the seller has already informed the staff, so it's actually working with these guys to get under the table. Number of targets currently, I think we've got 6 or 7 at the moment. We've got a couple in the US. Valuations, well, we've already discussed that already. We're looking at between 4 and 6. The US, somebody actually mentioned about the US, it's a little bit higher. They're looking at 5 to 7. So we're all in the similar ballpark, but we're not seeing anything sort of above that, really.
Is the 9 million of headroom available sufficient for meaningful M&A? Yes, the answer is in the short term. Yeah, there is. So management's process for dealing with slow inventory, we review it quite closely on a monthly basis and quarterly basis, and we put provisions in for slow moving. We have reports from each subsidiary. Organic growth, like in the April-August period, well, we've been in line with budget for April May-June. It's kind of what we've said in our report. In your federated business model, are there any costs, not benefits, of synergies? Interesting.
No, not at the moment.
Not really,
because everybody's being paid by their subsidiary. So we're not driving any additional costs through this. The fly costs virtually nothing. So not really. I think the pleasing thing for me is now everybody, all those 5 companies have actually bought into it. They understand it and they want to talk about it. So it's good for us. I think the major area for me is how you split the profit, because all these subsidiaries are bonus related on their profits, and making sure that the profits are allocated correctly if you go into a tender. So that's the only question I had from the subsidiaries, but that's it.
Could you elaborate on the COVID-related profitability of the revenue recognised in 23 of 8.5 million? Was it in line with profitability within the division? Yeah, it's circa gross margins of the division. Buybacks, no. We talked about, for Mike, for better recurring revenue, would you consider acquiring maintenance service or software-orientated businesses, please?
Software, I'm a bit apprehensive about. That's what my wife's involved in, so I don't really understand it. Service, maybe, but as I've already mentioned, we have got probably £5 to £6 million worth of service, and what we're trying to do is expand that internally. To tell the truth, it's not buying. So I think the answer, if you want a yes or no, is no, because it's cheaper for me to do it internally.
What are the drivers for the reduced forecast operating margins going forward? It's a mixed effect. Clearly, the Attic OEM had super profits really and that's operating leverage there, where you've lost the sales at the gross margin. It's replaced by acquisitions that have a lower net margin, and that's the driver. But we suggest that the pre-COVID margins between 15 and 20% seem a sensible range for this group. Would you consider hedging your interest paid rates? Yes, we would. It's always on the table. Valuation, what are the EBIT and EPS forecasts next year? I would suggest you have a look at the broker notes, and there's progressive notes. How do you source ideas for your acquisition pipeline? Do you get ideas also from managers of the divisions?
Yep. So there's a number of routes for that. So we have a third party, or a couple of third party people who are on commission only. But for me, as soon as you acquire the business, we do a presentation to the staff, and one of the questions top of the list is who should I acquire next. So we've actually been acquiring businesses through that. So a number of routes we get them. I've had sort of like 4 or 5 emails today from different corporate people about selling businesses, not just here, in Europe as well. So they come from a lot of areas because we're actually well known as an acquirer.
Okay, I think there's quite a few questions that we haven't quite managed to get to. I think we're nearly at the end of the hour. If we've got time, then what are the risk of further impairments given the Monmouth experience? That one is always, you have to do this every 12 months, and it depends on the weighted average cost of capital in 12 months' time, how performance is during the course of the year. There's lots of variables in this, and it's a mathematical calculation, really. So I can't, all I can guide you is to have a look at the annual report and see whether we do give some guidance where there's less headroom. Note 8 of the financials of the press release gives you some colour, and then annual report will be coming out within a couple of weeks.
Perfect. Michael, Ami, thank you very much for that. I think
Thank
you've
you.
addressed as questions you can from investors. And of course, the company will review all the questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors, provide you with their feedback, which I know is particularly important to the company. Michael, could I just ask you for a few closing comments?
Yeah, just a couple of sentences. Yeah, I'm pleased that we're finding businesses collaborating together. They're not just sort of standalone businesses. Synergy is a wonderful word, but I think it's coming together. I'll keep saying that right through my presentation. We'll continue to invest in companies to drive the organic growth within the businesses we've got, and we'll also evaluate businesses as they become available to bring into the SDI group. I think that's it. Thank you. Thank you for attending.
Perfect. Michael, Ami, thank you once again for updating investors today. Could I please ask investors not to close this session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of SDI Group PLC, we'd like to thank you for attending today's presentation, and good afternoon to you all.
Thank you.
Thank you.